Okay. The next non-DCF method is payback. Also, what is payback? Payback is a method to determine how long will a project pay back its initial investment. Okay, it means, for example, if I invest $100, so when will be my $100 back from this investment? Okay, payback, okay, is a bit better than accounting rate of return or ROCE because it concentrates on cash flow instead of profit. Okay, it's better. And payback is also suitable for evaluating projects with uncertain duration and with high research and development costs, which need to recover as soon as possible. Okay, here is another illustration sharing with you about the payback method. For the payback method, okay, here you take some time to read these questions, and then when you can see on the top right-hand corner, okay, it's page 4 in your course notes. So when you, for example, you just read through the question, if you finish it and just coming back, okay, you can pause it now. Okay, welcome back. For these questions, Ajax, okay, is a company concerned to purchase the sausage machine. The machine cost $12,000, 5 years, expected life, 0 scrap value. An expenditure of $8,000 on working capital will be needed throughout the project life. So altogether, okay, 12,000 plus 8,000 seems is the initial cost or initial investment. The accountant have estimated net after-tax operating cash flow, so it's shared operating cash flow to you of the project. First year, 6,000, second year, 6,000, third year, 6,000, and fourth year, 4,000, fifth year is 3,000. Then the question asked you is, if, for example, the company policy is we have to invest a project with 3 years payback. Please evaluate the project is worthwhile when using payback method and discount payback. Okay, discount payback, okay, we'll share a bit with you. It's a bit using the cost of capital concept. Okay, 10% cost of capital is applied. So first of all, we come to the first question, payback method first. Okay, here, okay, we will use this chart, okay, later about the discount rate. But first question is about payback method without any discounting. So let's see. As said, initial cost including 2 parts. Okay, the first part is the machine cost, which is 12,000. Okay, next part is the working capital, which is 8,000. So altogether, the initial investment is 20,000. So if using the simple payback, it means there's no discounting. Year 0, year 1, 2, 3, 4, and 5, for example. So year 0, initial cash outflow is $20,000. And first year, we have cash inflow 6,000. So we have only recovered part of it, right? The remaining is 14,000 that we have to recover in the following years. In second year, we have 6,000 cash inflow. So the remaining is 8,000 to be recovered. And for the third year, we have 6,000 cash inflow. So 2,000 left. So in fourth year, okay, we have 4,000 get back. Okay, so it's between 3 to 4. Okay, more than 3 years, but less than 4 years. So in practice, we have 3 years plus. Okay, because we have at the beginning of the year, we have the beginning of fourth year. We have $2,000 to be recovered, and in the fourth year we have 4,000 cash inflow. Assuming 4,000 cash inflow is coming through the year at the average, on average, okay, every month is coming the same amount. So assuming if average, then we have 3.5 year payback. Okay. So for discount payback, okay, let me check the table. Okay, here's the discount table. Because the cost of capital rate is 10%, and here we'll use 10% for example, 5 years maybe. We get first year 0.909, then 0.826, 0.751, 0.683, and then the last year is 0.621. Okay, remember these figures, then we go to the calculation. As said, we get first year, we get year 0, which is minus 20,000. And first year we have 6,000 with discount factor. Okay, first year is year 0 is 1. Okay, the year 0 is 1, and the first year after first year is 0.909. Okay, and the second year we get 6,000 too. The discount factor is 0.826, and third year, which is 6,000, and discount factor is 751. Fourth year, which is 4,000, and 0.683. Okay, and last year, if you remember in the questions, in the last year, I mean in the fifth year, the operating cash flow is 3,000. Okay, operating cash flow is 3,000, and the working capital should be recovered. Okay, given the project is profitable. So in the fifth year, it's 3,000 plus 8,000, which is the working capital that we turning to cash. So 11,000 in fifth year, and the factor is 0.621, and the discount payback okay. Year 0 is minus 20,000, and for the first year, which is 5,454. Okay, so the balance is 14,546. Second year, 4,956, and then we got the balance. Okay, so for year 5 and year 4, for the fourth year, you have 2,352, but in the fifth year you come back, the cash inflow is 6,831. So it means it is you have to spend more than 4 years, but less than 5 years for the project to pay back. Then you use a calculator to calculate how long is it. Okay, 4.34 years for the discount cash flow payback. So, referring to questions, because the maximum 3 years for payback criteria. So both methods is more than 3 years, right? The simple payback method here, 3.5 years, and for discount payback is 4.3 years. It means the project should be declined, should be rejected. So the weakness of payback. The weakness of the payback. First, all cash flows within the payback period are given equal weight, so there's no discounting. Okay, non-discounting. All cash flow within the payback period are given equal weight, and cash flow outside payback period are ignored. Okay, it's very important. For cash flows outside the payback period will be ignored, and only concerned with recovering of capital and not profitability. Okay. So again, why payback is used by finance professionals? Why they are still applied by the people in the field? Okay, here's a question asking you for it. Because it's easy. Okay, simple. I think simple is very important. It's very simple for the people to understand the information presented to them, and also the calculations are straightforward and likely to be error-free. Okay, when we're going back to see the calculations, yep. If we go back to simple payback method, you can see the logic is quite easy to understand. Okay, here is the initial investment, and the first part, and second part, okay, here you show the payback calculation, and third part is the conclusion. Okay, how you get the 3.5 years. It's straightforward and easy to understand. So in the market, The people would like to have simple and easy concept.